Time now for some Squawk Picks. Joining us now to talk about which tech companies you should look into, Toni Sacconaghi, Bernstein Senior Research Analyst. Toni, great to see you. We're heading into earnings season. The stocks have run up a lot in the first half. Who do you think has the best setup?
Well, good morning, Melissa, and thanks for having me on the show. Look, I think the thing about technology that's been so striking this year is you've really had very concentrated performance from 6 stocks that have driven the entire tech outperformance. So if we look at the first half, tech stocks on a cap-weighted basis were up 38%. Non-tech stocks were up 6%. All of that outperformance was driven by the big 6. So those are, the Microsoft, Amazon, Google, NVIDIA, Meta, and Apple. And I think the real question is, how do you go from here, given you've had this tremendous outperformance among these 6 stocks that have driven the market? And I think it's a very tough question, because when we look at historical markets where you've had very, very concentrated returns, markets generally do okay in the following 6 months and 12 months. But the stocks that drove that outperformance typically underperform by a bit. So I think the operative word is really to try and be selective. So you really have to have conviction on the names. Now, within that coverage universe, I follow Apple. We have a market weight on Apple. Historically, Apple does very well this time of year. It outperforms in the June to September timeframe, typically the March to September timeframe. And then it takes a breather when a new iPhone cycle comes into play. And so, my observation on Apple is you can probably ride this stock for another month. I think earnings will be fine. There aren't really high stakes. But typically after about September 1st, you may want to move more towards a market weight. Some investors even believe maybe a little bit of an underweight in Apple because it's a seasonally weaker period. And Apple is at its most expensive period in the last 10 years.
We're seeing a broadening out overall of the markets, Toni. I mean, we just had industrials hitting a record high in yesterday's session. So I'm wondering, within your coverage universe, are you also guiding clients to rotate into some of the names that haven't seen as stellar performance, particularly when we're even seeing the NASDAQ 100 rebalance, which will effectively reduce the impact of the big 6 that you're talking about?
Yeah, I really do think the rebalancing could be a material impact as well. So, yeah, we're recommending to clients that they look to the barbells of technology. So what's happened is you've had these big 6 stocks, which aren't hyper growth per se, other than NVIDIA, drive the market. But you've started to have growth, and you started to have more reasonable valuation and some other higher growth names, and value stocks have not performed particularly well. So a couple of value stocks that we like within our coverage universe are Dell Technologies and Hewlett-Packard Enterprise, HPE, not HP Inc. Both stocks are trading at about 10 times earnings. HPE has a ton of cash, so it's a $22 billion market cap. By the beginning of next year, they'll have $6 billion in net cash. So you have an enterprise value of about $16 billion. And they have a terrific networking business called Aruba that we think alone is worth $10 to $15 billion.
Right.
So we think there's pretty compelling valuation support for Hewlett-Packard. For Dell, we think the stock's also attractively valued. It is not in the S&P 500 index. It now qualifies to be in. And we think it could be included in the index over the next 6 to 9 months, which could be a catalyst along with the PC cycle coming back.